Hi, I'm Abolore. On today's episode, we'll be looking at double entry system of accounting. So, the double entry system of accounting was founded by an Italian mathematician called Luca Pacioli. Luca Pacioli, let me put out on the board. Luca Pacioli. Luca Pacioli in 1494 published a book called Somma de Arithmetical Geometrical Proportionalita. It's an Italian word. That's why you see me having trouble pronouncing it. But in English language, it means everything about arithmetical, geometrical, proportional, and all that. So in this book, Luca Pacioli was explaining, or let me say, he codified, it documented all the business terminologies that were used in Italy back then. So some of those terminologies he explained in this book were journal, ledgers, financial statements. He explained debit, what debit means, what credit means. He also explained in this book the double entry system of accounting, which we also call double entry bookkeeping. So double entry system of accounting is what we are going to be looking at today, what it means and all that. So let's start. Like I said, double entry system of accounting is also called double entry bookkeeping. So double entry bookkeeping, now let's explain it. What does it mean? From the word double, double means two. And double entry system of accounting explains that a business transaction should be recorded twice in the books of accounts. The reason being that in every transaction, in every financial transaction, there are always two parts, and that's the giver part and the receiving part. Therefore, two accounts should be opened where the business transaction will be recorded. So what double entry system or double entry bookkeeping is just saying is that record a business transaction twice in the books of account, because there are always two parties who are usually the giver and the receiver, or the buyer and the seller. Now, let me also stress why a financial transaction is recorded twice. Now, in financial accounting, or in accounting as a field, there are what we call accounting concepts, conventions, policies, procedures, and all that. Now, let me stress on accounting concepts. Accounting concepts are basic assumptions upon which the preparation of financial statement is based. That means for the financial accountant to do his recording, to prepare the financial statement, the accountant must follow some basic assumptions upon which he or she must be guided in preparing the financial statement. And one of those assumptions is the DRA concept. DRA. DRA means DRA concept. DRA concept, from the word DRA. DRA means two. And this DRA concept supports that a business transaction should be recorded twice in the books of accounts. And this DRA concept was what gave birth to the accounting equation, which is the fundamental of accounting today. So accounting equation, this DRA concept gives birth to the accounting equation, which is also saying that in every transaction, in every business transaction or financial transactions, there are usually two entries or two parties. So the accounting equation, like you all know, is equal to assets equals capital plus liability. Capital plus liability, that's the accounting equation. And don't forget, this accounting equation gives birth to the balance sheet, which is the same thing as the statement of financial position, which we usually prepare for sole trader, for companies and all that. So two parts to every business transaction. So the asset of a business belongs to the owner of the business as well as what? Outsiders, which are usually the creditors, the liability. We're going to come back to accounting equation in our subsequent episode. So two reasons now why a business transaction is recorded twice. The first is the concept of double entry system, which stressed that a business transaction should be recorded twice. And I've been able to explain that because there are two parts or parties to a business transaction, the giving part and the receiving part. So open two accounts, one for the receiver where the transaction will be recorded, and one for the giver where the transaction will be recorded. And also, the draft concept supports the double entry bookkeeping, which states that a transaction must be recorded twice in the books of account. And this draft concept, like I said, gives birth to the accounting equation. An accounting equation, like you all know, is capital plus liability. If you want to get your assets, capital plus liability. So these two are the two entries that must be passed in every business transaction. Every business transaction has two parts. That's basically that. So having understand the double entry system of accounting, let's talk about its components, because double entry system only talks about record a business transaction twice. So let's talk about some of its components. We have just two components of the double entry system of accounting. We have the double entry principle and we have the double entry rule. So let's start with double entry principle. Double entry principle. Double entry principle established that the double entry for a transaction should be completed by debiting one account and crediting the other account. That means in every transaction, in every financial transaction, double entry principle is saying one account must be debited and the other account must be credited. So it will be an error whereby in a transaction you are debiting one account twice or you are crediting one account twice. In accounting, that's an error, and we call that error of partial reversal of entry. Partial reversal. When in a transaction you are debiting one account twice or you are crediting one account twice, that's an error, and that means you have violated the double entry principle, and which states that if you are debiting one account, you must credit the other account. So in this case, you are now debiting in a transaction, you are debiting twice or you are crediting twice. So when you are debiting twice or you are crediting twice in a transaction, you have committed an error called error of partial reversal of entry. So in summary, what the double entry principle states is that for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. So, excuse me. So what that means is that, let me rub off this part so what double entry principle explains is that if we have in a transaction, let's say this is A account and this is B account. In every transaction, you will have two parts. That's the A and the B parts. So this is the debit side, credit side, sorry. This is the credit side for this A account, and this is the debit side. That's the debit, the credit for A. Then for B, you have the debit, then you have the credit. This is the debit side. This is the credit side. So what double entry principle is saying is that if, let's say, this is a transaction and you have A and B to be involved in a business transaction, if you are crediting B's account, you must debit A's account. Or if you are crediting A's account, you must debit B's account. It's as simple as that. So the summary of double entry principle is that for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. That's that. And I did say, if you violate this double entry principle by debiting one account twice or crediting an account twice in a financial transaction, you have committed an error called error of partial reversal of entry. Error is a topic on its own, which we are going to be looking at in a subsequent episode. So uh, please, if this is your first time watching our video, please do subscribe to our YouTube channel and share our videos with friends and relatives. Thank you all in advance. So that's what double entry principle talks about. Now, remember that double entry principle doesn't specify the account to be debited and the account to be credited. It only tells us excuse me, that in a business transaction, one account has to be debited and the other account has to be credited. It did not tell us that, okay, debit this and credit this. But double entry rule now. Double entry rule is saying that to complete the double entry for a transaction, debit the account that receives and credit the account that gives. That means the debit entry for a transaction should be passed in the account of the receiver, and the credit entry for a transaction should be passed or made in the account of the giver. And the summary of double entry rule is just simple. Debit the receiver and credit the giver. It's as simple as that. Now, you may want to ask the practicality of this double entry rule. Very simple. Let's say, for example, you have a bank account. Most times you will go to the bank and make a withdrawal at the counter, or you go to the ATM machine, that's automated teller machine. You make a withdrawal as well. Making a withdrawal means you are receiving money from your bank account. Although you are a bank customer, you are withdrawing money, you are receiving money. So each time you make a withdrawal from your account, it means you are receiving. And in that regard, your account will be debited. It's as simple as that. Then on the other hand, let's say you also have a bank account, because there is no how you can make a withdrawal at the bank without you having a bank account. Let's say you have a bank account now and you are paying money into your bank account. If you pay money into your bank account, it means you are giving money to the bank for them to keep for you. So in that regard, since you are giving, your account will be credited. It's as simple as that. So double entry rule states that debit the account of the receiver and credit the account of the giver, which is usually summarized as debit the receiver and credit the giver. Simple. So if you violate this double entry rule, don't violate it. But if you violate it, it's an error. And that error in financial accounting, we call it error of complete reversal of entry. Error of complete reversal of entry occurs when you have debited an account that ought to be credited, or you have credited an account that ought to be debited. For example, let's say you pay money into your bank account. That means you are giving the bank money. Instead of your bank account to be credited, the bank now debits you. The bank has committed an error, which is what? Error of complete reversal of entry. An error of complete reversal of entry occurs when the double entry rule has been violated. It's as simple as that. So we have been able to talk about the double entry system of accounting, which states that record a business transaction twice, and that is supported by two reasons. There are always two parties in a business transaction, the giving and the receiving. And we said the drag concept. The drag concept supports the double entry system or the double entry bookkeeping. Record a business transaction twice. And I said the drag concept gives birth to the accounting equation, which is asset equals capital plus liability. And we also talked about double entry principle, which is one of the components of the double entry system of accounting. And double entry principle, in summary, it states that for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry in a financial transaction. Simple. Then the last double entry rule. Double entry rule states that debit the receiver and credit the giver. If an account is given, such account should be credited. And if an account is receiving, such account should be debited. Simple. So what we are going to do now is we want to practice, or we want to complete the double entry for some business transactions which we might have in financial accounting. So we want to be debiting and crediting. So let's quickly do or practice one or two transactions for which double entry system could be completed for. So let me cover this part. So now that you've understood the double entry system, the double entry principle, the double entry rule, let's practice some questions. Now, before I proceed to completing a double entry for business transactions, most times, if you want to complete the double entry for business transaction, there are some steps that have to be followed before you can complete the double entry for business or business transactions. So I would advise you take this down while you are watching now, because I know some of you are live now. So take this down. Step 1, we have about step 3 or 4 like that. So take those steps down, and those steps will guide you as regards completing the double entry for business transactions. So step 1, identify the two accounts involved in a business transaction. I repeat, identify the two accounts involved in a business transaction. So in every transaction, you will have two accounts. That's the giving account and the receiving account. Step 2, determine the account that receives and the account that gives. So in a business transaction, one account must be giving and the other account must be receiving. Now, how do you know if an account is giving or an account is receiving? Any account that reduces is giving. Any account that decreases or reduces, such account is giving. And any account that increases, such account is receiving. So any receiving account must be debited and every giving account must be credited. It's as simple as that. That's step 2. Then step 3 now. Debit the account that receives and credits the account that gives. We are coming back to double entry rule now. Step 3 now, I repeat. Debit the account that receives and credit the account that gives. That's step 4. Perhaps in our subsequent episode, when we'll be treating lots of business transactions, perhaps that is going to make a lot of sense. But for now, since we want to be doing or want to be completing the business transaction for an individual transaction, so that may not necessarily mean a lot here or be useful here, because step 4 is just all about do not open one account twice. Do not open one account twice. But because we are just doing individual or we are completing double entry for individual business transaction, that's is not necessary here. So come with me. So let's start with let's say 1/1/2020. Started business with check. Started business with check, 200 naira. Now this business transaction is obtained from the book of a business organization. So we are assuming that, okay, let's say the name of the business is XYZ Limited. So XYZ Limited started business with check 200. So let's complete the double entry for this transaction. Completing the double entry for this transaction means you debit one account and credit the other account. So let's begin. Started business with cash. Anytime you are given started business with cash, the first account you are going to open is the capital account. Anytime you are given started business, I repeat, anytime you are given started business with something, the first account you are going to open is capital account. Then what the owner of the business starts the business with? Then in this case, it's not check. There is nothing like check account. We call it bank account, because check cannot be classified into any of the accounts that we have, because we have two basically classification of accounts. We have personal and impersonal. So check is not one of those. So we represent it with bank account. Now let me go further on why it is the first account is capital account. Like I said earlier, I did say financial accounting is governed by concepts and conventions. Concepts are broad basic assumptions upon which the preparation of financial statement is based. One of the concepts we are going to be, or that relates to this completing of business transaction, is the business entity concept, or most times some scholars call it entity concept. Is the same thing. That entity concept, what it explains is that a business should be treated separately, different from anybody or anyone that has economic interest in it. Be it the business is a sole proprietorship, is a partnership, is a company, or any other business. Such business must be treated separately, different from the owner of the business. So what that means is that any personal transaction of the owner of the business must be recorded in a separate book, and any business transaction that relates to the business must also be recorded in the books of the business. Now, since we said the business should be treated separately, different from the owner of the business, in this case, what we mean by that is this is the business. Let's say this is the business now. This is the business. This is a business. Then the owner of the business, don't mind my drawing. This is the owner of the business. They are two different entities. That's why in accounting, we usually see a business as an artificial scarcity, artificial person, sorry, artificial person. And the owner is also an entity on its own. So they are two different things. So anything the owner gives into the business will be recorded as capital. And anything the business gives to the owner of the business will be recorded as drawings. So I repeat, anything the owner gives to the business will be recorded as capital, or it's called capital. Then that capital will now be recorded in a capital account. And anything the business gives to the owner of the business is called drawings. And drawings, okay, let me put it here. We have drawings. Drawings is whatever the business gives to the owner of the business for personal use or personal consumption or for private use. Anything the owner takes out of the business for personal use or consumption is called drawings. And anything the owner gives to the business for the business to expand or to keep going and all that, or to keep operating, we call it capital. Capital. So capital will be recorded in a capital account, and drawings will be recorded in drawings account. So in this regard, started business, the owner is starting the business, is giving the business something. That's starting the business with money paid into the bank. So the owner is paying the money into the bank is receiving it. Then the owner, which is the capital, is receiving it. The capital is giving it, then the bank is receiving it on behalf of the business. So here now, we will have two accounts. The first step says identify the two accounts involved in a business transaction. So the two accounts here is capital accounts. Then we have bank accounts. Don't forget, I did say the business entity concept states that the owners should be treated separately, different from the business. So they are two different entities. So the owner is giving the business something now, which is called capital. And the business is receiving it. The bank is receiving it on behalf of the business, which is bank. So the two accounts here is we have capital accounts, and we have bank accounts. That's the two accounts. The first step now, which is identify the two accounts involved in a business transaction. So we have debits. So we have credits, we have debits. So you put your Naira sign here. The currency you are given, you have to put it, very important. So that's the first step. Then the second step says determine the account that receives and the account that gives. So the owner is giving the business money, which the bank receives. So the capital is the giver, then the bank is the receiver. That's the second step. The bank is receiving the money on behalf of the business. The owner is giving the business money. So the owner account will be credited, which is capital account. Okay, so there are two accounts that are specifically used for the owner of the business. The two accounts they are personal accounts. We have capital accounts and drawings account. They are specifically used for the owner of the business. So this is used to record anything the owner takes out of the business for his own personal use. And that can either be cash or goods, that's stock. Then this capital, the owner can give the business cash, check, maybe machine, or any other equipment, but it must be quantified in money terms. So this capital account is always giving, while this drawings account is always receiving. And don't forget, they represent the owner of the business. So drawings account, when you hear drawings account, think of the owner of the business. When you hear the capital account, think of the owner of the business. Think that the owner of the business is given when you hear capital account. And when you hear drawings account, think of the owner of the business receiving. That's that. So drawings account we always receive. Capital account we always give. That's just it. So we have identified the two accounts, capital and bank. Then we said the capital account is giving the business. Then the bank account is receiving it on behalf of the business. So the third step, debit the account that receives and credit the account that gives. So we are going to be crediting capital account, credit. Then we are going to debit bank account. Why are we debiting bank account? Because bank account is receiving on behalf of the business. And why are we crediting capital? Because the capital, the owner of the business, is giving the business the money. So we are going to credit capital account and debit bank account. So let's credit capital account. So we have the date is 1/1/20. The particular here, which we usually call details. The details, who is capital, the owner of the business, paying or giving the money to is what? The business. But who is receiving it? Bank account. So you have bank. How much? That's 200. And for every credit entry, double entry principle now, for every credit entry in one account, there must be a corresponding debit entry in another account. So in bank account now, we are going to debit it since we already said that. So the date, we are the same date. The same date is 1/1/20. Then the particular now, who is, the bank receiving the money from the owner of the business, which is capital account. So you write capital, the particular will be capital now, or the details. That's the same amount, which is 200. So this is with respect to started business with check 200 naira. So we have been able to complete the double entry for this transaction. So let's go to another one. I hope this is understood. So in the comments, you can always tag the particular area you do not understand so that I can, do a brush up on that. Thank you. So let's go to another transaction. So another transaction now. Let's say we have paid insurance. It's still in the books of SYZ. Paid insurance by cash. Paid insurance by cash, 100 naira. Paid insurance by cash. The first step here is the two accounts involved. So we have insurance. Insurance account is the first account, and we have cash account. Insurance and cash account. Who is paying insurance? Cash. Simple. Who paid insurance? Insurance was being paid. Let's say I'm the insurance. I am being paid. That means I'm receiving. So that's that. So who is paying insurance? Cash. So since insurance is receiving, that's cash is giving, insurance is receiving. The two accounts first, insurance and cash. Then determine the account that receives and the account that gives. That's the second step. The account that receives is insurance. The account that gives is cash. Then we debit the receiver and credit the giver. So we debit insurance and credit cash. We credit cash. That's that. So let's open the two accounts. So we have insurance and we have cash. So this is cash account. We have the credit side, we have the debit side, we have the credit side, we have the debit side. So put your Naira sign because I am in Nigeria. So we are going to debit insurance and credit cash. So let's debit insurance now. So this is insurance account. Insurance account. So we want to debit it. The date is, let's say, 2/1/20. That's the date. Every transaction must have the date they occur or it occurs. So the date is 2/1/20. Who is paying insurance? Who is insurance receiving from? From cash. We have said it here. Cash paid insurance. So cash is giving, insurance is receiving. So how much is that? That's 100 naira. Then for every debit entry, there must be a corresponding credit entry. That's double entry principle. So the date, the same date, 2/1/20. Who is cash paying insurance? That means XYZ is paying insurance. That's what it means. Perhaps insurance premium. Maybe they insure one of their assets and all that. So insurance, that's insurance. That's 100. So this is it. It's as simple as that. I hope this is understood. Good. So let's take another example. Let's take another example. Let's say purchase goods by check, 15 naira. All these transactions are not realistic. They are just assumption. So 15 naira, you can't purchase 15 naira goods. Or a business could purchase that. I don't know. So let's say 4/1/20. That's the date of the business transaction. Purchase goods by check. Now, if you take a look at this, XYZ purchase goods by check. That means XYZ has a bank account. Then when they purchase the goods, the bank page on behalf of XYZ. So the bank is paying for that purchase. Then purchase, we are receiving the goods. XYZ is receiving the goods. So purchase account is receiving this money or the goods that was purchased by XYZ, then the bank is paying. Purchase goods. When you purchase simply means you are buying in large quantity for the purpose of resale in bits or in units. That's purchase. So when you purchase, it simply means you buy. So that's just what it means. So purchase account is an expenses account. Yeah, it's a nominal account, it's an expenses account. So it's always be debited. Then the corresponding account will be credited, which is bank here, not check. So let's open purchase account. Then we also have bank account. So we have bank account. So the two accounts here, first step, that's purchases and bank, not check. Then we have purchases accounts. Purchases accounts. We have the credits, we have the debits. We have the debits, we have the credits. So put your sign, your currency sign, very important because of the money measurement concept. We're going to be looking at accounting concept as a topic in our subsequent episode. That's why you need to subscribe to our channel and ring the notification bell so that you will be the first to get notified each time we put out a video. Thank you all in advance once more. So purchase is receiving. Purchase is receiving account because purchase was being paid by bank. So bank is the giving account. Purchase by check. The bank is the one paying for that purchase. So purchase account is receiving. We are using purchase account here because the goods that was purchased was not mentioned here. If the good purchase had been mentioned here, let's say purchase stationery, this would have been stationery account, not purchases again. But the goods that was purchased was not mentioned. If it had been purchase equipment, it would have been equipment account and bank account. But because the goods that was purchased was not mentioned, then we have purchases account and bank account. So we are going to debit purchase. This is the short form of debit, and this is the short form of credit. So we are going to debit purchases. So in debiting purchase, the date 4/1/20. Then we have the particular. Who is paying for the purchases? The bank. Then how much is that? That's 50. Then for every debit entry, there must be a corresponding credit entry in the bank account. So the date is 4/1/20. Particular will be what is bank of XYZ paying for? That's purchases. So purchases now. Purchases. And that's 15 naira. That's that. So for every debit entry, there must be a corresponding credit entry. That's that. Then let's take the last one. The last one. I hope all this is understood. Good. Okay. So let's take the last business transaction before we wrap it up for today. Then in our subsequent class, we'll be taking volumes of business transactions, and we're going to be doing the same. What we are doing now, we're going to be doing it for those business transactions. That means completing a double entry for the business transaction. So let's say we drew, let's say 5/1/20. We drew cash for personal use. We drew cash for personal use, 3 naira. Look at this transaction. We do cash for personal use. Anytime you have withdraw for personal use, it is called drawings, which I talked about earlier on, drawings. And what this means is that the owner of the business is taking from the business for his own personal use. That's drawings. So which account is that going to be recorded? That is drawings account. So drawings account is receiving that money. Then who is giving that to drawings account? It's cash. It withdraws cash from the business for his own use, the owner of the business now. So the owner is receiving, and the account that will represent the owner of the business when he receives or she receives is drawings account. And don't forget, the opposite of drawings is capital account. And I said They are both personal accounts, which are used to record whatever the owner takes out of the business, that's drawings account, and whatever the owner puts or contributes into the business, and that's capital account. And I did say that's the concept that supports that is the business entity concept or the entity concept. So anytime you hear withdrew for personal use is drawings. But the opposite of this could be withdrew cash for business use. For business use is not drawings. It's called contra entry. But we're going to get there when we get to cash book. That one is called contra entry transaction, which involves the lodging of cash between the office and the bank, or the withdrawal of cash from the bank for business use. That's contra entry. But this is drawings because of the personal use. So the two accounts here is we have drawings account and we have cash account. Cash account. And we have drawings account. So we have the credits, we have the debits. We have the debits, we have the credit. So drawings account always receives. So it will always be debited. And the account that is giving that to the owner of the business is cash. So cash account is giving, is reducing. Then drawings account is receiving, is increasing. That's what it means. So the two accounts is drawings and cash accounts. Then drawings account will be debited, will always be debited. Drawings account will always be debited. Why? Because it's always receiving, and every receiver must be debited. Then cash account will be credited. If it is withdrew check for personal use, withdrew check for personal use, it will be drawings and bank accounts. So bank account will be credited and drawings account will be debited. Drawings account will always be debited. So then we debit drawings and credit cash accounts. So let's debit drawings now. The date is 5/1/20. Particular. The drawings, the owner is making it in what form or is withdrawing in what form? Cash. So cash. And that's the amount is 3. You put your naira sign. For every debit entry, there must be a corresponding credit entry in cash account. So the date is 5/1/20. Then cash is paying which account? The owner of the business. But which account represents the owner of the business here? That's drawings account. So drawings, and that's 3 naira. So for every credit entry, there must be a corresponding debit entry. And for every debit entry, there must be a corresponding credit entry. That's that. So that's where we are going to draw the curtain for today. If this is the first time we are coming across our video, please give our videos a thumbs up, give it a like, and don't forget to subscribe to our YouTube channel. Support us in any way you can by sharing our videos to our friends, to groups. Don't be the only one that will be enjoying this. So I say a big thanks to everyone. Have a good day ahead. I'll see you on my next video. Bye-bye.